and welcome to this special weekend market show, The Fear Factor, What the World Thinks. Most global indices like the Nasdaq, the Nikkei, Shanghai Composite, CAC, DAX have all fallen between 15 and 25% in the first 5 weeks of 2016 on fears of recession. Today we get you two experts on global markets and the global economy to check if indeed the world is in a recession. Joining me first on the show is Russel Napier of ERIC, E-R-I-C. In a bit, we will get you Didier Borowski, the economist at Amundi Asset Management Company, one of the largest European funds. But first, Mr. Napier, welcome to the show. Well, the global economy and its jitters have dominated investor concerns, and we are eager to know your interpretation of the global economy and how it may pan out.
Markets are moving very quickly. When they move this quickly, I think it can be only discounting one thing, which is deflation. At least history tells us that markets react particularly quickly and viciously to deflation. Now, what that means for an investor, we should just, I think, call it falling cash flows. Cash flows are coming down. Well, we all know they're coming down for commodity-producing companies, for oil-producing companies. Actually, with exchange rates falling in emerging markets, they're also coming down for people trying to service their foreign currency debt if they have revenues in those emerging markets. There's all sorts of pockets of falling corporate cash flows. And the reason that that has such a dramatic impact on the price of financial securities is it raises the prospect that there will be insufficient cash flow to pay liabilities. Now, that has an impact for corporate bondholders, but obviously crucially has an impact for equity holders as well. Now, in the great big scheme of things, this is very, very important because we are now in our 7th year of quantitative easing, 7th year of extreme monetary policy that was supposed to stop this from happening, and 7 years after it's happening again. So there are two reasons why the markets are very jittery. Number one, falling corporate cash flow threatens many, many prices of financial assets. But number two, and perhaps ultimately more importantly, a real fear that our policymakers and central bankers don't have a remedy for this problem. And I think really for the last 6-7 years there's been great faith that they do, and that faith is evaporating.
Just to expand the horizon, what kind of impact do you think we may see in emerging market economies as this recession fear runs?
Well, for some time now people have been aware that things are going wrong in the emerging market economies. They're defending their exchange rates, and that ultimately in some shape or form has to mean tighter monetary policy and lower levels of growth, and that's been accepted for some time. I think what people haven't focused on enough for those economies is just how many of them might end up defaulting in some of their foreign currency debt. But that's a focus that markets have had now for some time. The new focus, and the reason why things are moving pretty rapidly in 2016, is people are beginning to realize the feedback loop onto the developed markets. And I would say there's lots of mechanisms through that, but I would say a key one is real rates of interest. So for instance, if we just pick the corporate bond market in the United States of America, in real terms interest rates are soaring. Inflation has come down from 4% in 2011, close to zero. Corporate bond yields are going up. I think this is directly related to what's going on in emerging markets. Number one, America's importing deflation, suppressing inflation. Corporate cash flows are suffering from a stronger dollar. But then more importantly, and something just changed for the first time really in a generation, which is there are no remaining central bankers who are currently printing money to buy treasuries. So from 1994, when China devalued, to 2014, foreign central bankers created liabilities to buy treasuries. The Fed got involved in that heavily in 2009, and they really took the burden off the global saver. These are the institutions, these central bankers, that don't have to sell an asset to buy an asset. They create a liability. It's almost free finance for the United States government. And what we see today is actually foreign central bankers selling treasuries. Now, someone's buying them, the yields are not going up, and that's the saver. So the saver has to sell an asset to buy an asset. He's reallocating his capital to fund these governments for the first time in a generation. The saver has to fund the state, and therefore there's a dislocation. So the direct feedback loop from emerging markets into the developed world is pushing up nominal yields on corporate bonds, pushing up dividend yields by pushing down equity prices, bringing in imported deflation. Real rates are going up, economic growth is slowing. So it's taken a while, I think, for the markets to realize that there is a feedback loop to the developed world. But now it's the developed world's turn to feel some of this deflationary pressure.
Okay. Well, Mr. Napier, then what do you think of China? Do you think there is a transformation happening from an investment economy to a consumer economy? But does that mean a slowdown?
China has problems, but they're problems which are not difficult to solve, which is not the consensus view. And that is a devaluation with a very easy monetary policy. Printing lots of money would solve the problems. Does it solve the problems in the long term? Obviously not. But easy monetary policy, high levels of credit growth and money growth can hide things for a prolonged period of time. But that's the problem. The solution to China's problem lies through a lower exchange rate. And that lower exchange rate clearly has significant negative impacts for the rest of the world. So I'm not one of those people who says China's going to collapse and there's going to be a great credit crisis and it's going to fall apart. It'll probably pretty much continue as it's doing, but it can only do so with a major increase in the supply of credit, a major increase in the supply of money, and as a consequence, a major decline in the exchange rate. So investors should prepare for that. And preparing for that means, a focus at this stage on deflation. Just one thing beyond that, and we shouldn't really get beyond that because that's going to be a very major negative implication. But it will raise the tantalizing question when that's completed as to whether China has moved to a new era of an entirely independent monetary policy, a monetary policy fit for purpose, a monetary policy designed to take it beyond mercantilism towards a more consumer-orientated growth strategy. And we can't know that it will do that. But with the exchange rate policy gone, it would have many more options to do that. So we need to be careful, and we need to be cautious when this exchange rate movement comes along. But we need to keep an open mind because it may allow China to grow in a whole new way going forward, which would be pretty optimistic for the world. But we've got to get through this difficult step change in the Chinese exchange rate first, and that's a deflationary step change.
Mr. Napier, your take on the developed economies. There are divergent moves coming from the central banks in Europe and in the Fed, and as a result, currencies are causing turmoil. How will all this pan out?
Central bankers are very aggressive. They're creating a lot of money, and it's also known as a currency war because the natural consequence of doing that should be that your exchange rate goes down, but of course they're all doing it. So in that scenario, how do we know which one is going to go down the most when they're all doing it? I think you would focus on the one where it would be very difficult to reverse that policy. I'm a bear, I'm a deflationist. I don't believe they're going to create a lot of inflation anytime soon, but eventually they will. And then the question is who can reverse and who can't reverse. And for some time now I've been really concerned that Japan would not be able to reverse this quantitative easing policy, because lying behind it is something much more fundamental than the desire of the central bank to create money. And that is the fact that the government is really running out of savings pools to tap into to fund itself. That government debt to GDP ratio is very high. It's almost entirely funded by locals. And if you look at the savings pool in Japan, it's dominated by JGBs. So if it starts to work, if we start to get growth, and this is not my forecast for the world, but if we start to get a pickup in inflation, I don't think the Bank of Japan will be able to stop, because who else will fund the Japanese government? Now, a central bank that can't stop expanding its balance sheet, that's the one that really sees a major move in the exchange rate. So looking forward a couple of years from now, I would expect to see a significantly lower yen. We've already discussed a significantly lower Chinese renminbi. And what that means is victory for North Asia in the currency wars. So North Asia wins the currency wars. It runs a social system which is always emphasizing full capacity utilization, full employment. And therefore it fits social policy as well. If you can get these exchange rates down, take market share. So I think that's what we should look to. Now, the really key question, which I don't think any of us really know the answer to, is what would the political ramifications be from a North Asia that wins the currency war? And I think simply we just have to wait and see what the political ramifications would be.
Well, Mr. Napier, I know you're a long India watcher. So how do you read India's handling of the windfall it has got from lower crude prices? As you well know, 70% of this has been retained by the government.
I have been very positive on how the Indian authorities have been handling the economy for some time now, but particularly the central banker. I think it's a bias of someone who's interested in financial markets to more focus on central banking as a policy tool than the other tools. But the central bank has really generally stayed as far away from currency intervention as possible. I think that's been a good thing. And it means that they haven't created a lot of excessive money and credit in the system, or at least relative to other countries they haven't done so, and therefore they're in a more robust situation to deal with the adjustment. And as we know, they benefit to some extent from falling global commodity prices. These are the upsides for India. This is why the system, I believe, is somewhat more robust than others. The foreign currency debt to GDP ratio was much better than other people, though it's not ideal. So it's a system, and I think mainly due to the activities of the central banker, a system that is somewhat more robust. That's not the same as being optimistic about the outlook for India in the sort of global economy we're talking about, particularly in an economy where there's significant exodus, I believe, still to come of capital from emerging markets. And the one thing that does worry me about India really is the amount of foreign capital which is in the domestic debt market, which is a new thing for all the emerging markets, but has also crept into India. And I would be concerned if there was a liquidation there. I think there will be forced liquidations of emerging market debt through open-ended funds, and I think India will actually be in the line for some of that as well. So that's one negative. But on the whole, from 2009 to 2016, the flexibility in the exchange rate meant that India stayed away from some of the bigger excesses that other emerging markets did. Not all of them, but they fared better, and therefore structurally they're in a more robust position.
All right, and now to come to the upcoming event, the budget. What can the Indian Finance Minister do differently in the budget this time?
Well, I mean, obviously I've got a very unique perspective coming from outside of India, and there'll be lots of things that people in India would want to help the people of India. Ultimately, however, there is a great opportunity building for India here. Foreigners are not as optimistic on emerging markets as they have been. They're raising some structural issues for some of those emerging markets. They're raising some structural issues about the ability of an export-led growth model to prosper in a world of an ageing global population where demand for goods is coming down. Now, India is not built its success upon exporting goods to the baby boom generation. It is a different position, and is in a really wonderful position to capitalise on this. So what I believe, and I know India has a long troubled history with foreign capital and foreign capital investment, but really the opportunity is as foreign capital loses faith in other forms of models, whether they would be the commodity models of South Africa or Brazil, or whether it's the consumer goods model of Korea or China, that really India stands out as a place that could attract significant amounts of capital going forward. So anything that the Finance Minister can do in that regard will be incredibly useful. And I think we all realise that the best capital is long-term capital. So really a focus on getting more foreign direct investment. And with other business models clearly under pressure, India has a real opportunity to get and attract foreign savings and therefore speed up the development process.
Mr. Napier, it was a pleasure speaking with you. Thank you very much indeed for joining us in this special show. We take a quick break, and thereafter, Didier Borowski, the global economist at Amundi Asset Management Company, joins us. Stay tuned.